I think innovations like what you all are doing at Clair and what we're doing at Prism and combining real-time data, bank data, payroll data, that has the ability to fill in these blind spots and close the gap, giving much more people access to credit at lower cost. And that in turn drives the economy, drives upward mobility for consumers. There's all kinds of great things that can accrue from that.
Hello everyone, my name is Nico Simko. I'm one of the co-founders and the CEO of Clair. Today I'm super excited to have Jason Rosen join us for a new episode of HR Tech Trailblazers. The reason why I wanted to have Jason here is because he is working in one of the coolest advancement in financial technology that's going on in the consumer world, which is cash flow underwriting. Jason has been in the space for quite a while, and I think he can share with us what is going on and how advancements in technology can offer better forms of capital to average consumers in this market. And so with this, Jason, welcome.
Thanks for having me.
All right, well, Jason, I'm gonna start with a very important question to me as a founder, which is you have an incredible track record. Why, of all the things you could do in the world, are you building Prism?
Yeah, it's a great question for any founder, right? Because these journeys are long, and it's really important to have a powerful purpose behind what you do. For me, I've been working to solve the same problem or the same set of problems for almost 10 years now. And it started with a realization that our economy, our society was very much being held back in material ways by a lack of reliable credit information, by the limitations of legacy credit scores. And like a lot of founder type stories, it began with some personal anecdotes. One of my co-founders came to the US as an international student and was a brilliant guy. He was getting a PhD at MIT, but he couldn't qualify for a credit card. And he couldn't sign a lease on an apartment easily because he didn't have a US credit score. But if anybody had looked at his situation more holistically, if they had taken the time to understand his actual finances, his actual potential, they would have been glad to have him as a credit card holder or as a tenant or any of those things. His research at MIT centered on applied machine learning, AI, and data science to high stakes decisions. And we started thinking about, well, not only the fact that he experienced this great inconvenience in his life, but the number of other people that are impacted. And I think that we were shocked to learn how many people are held back or shut out of traditional financial services because they lack the data that lenders are used to using to make decisions, or because that data misrepresents what's going on in their financial life. So the short answer to your question is, we, in some ways, by happenstance, stumbled into a problem that ends up impacting tens of millions of people's lives and hundreds or billions of people globally. And that's the kind of thing that I think has really fired me up and fires up our team to work on solving.
So maybe for those who don't know, how do credit scores actually work? I think most people know that the number's there, but How do they work? And why are they so inefficient still today?
Yeah, we're all, for the most part, familiar with credit scores now and have had to learn roughly how they work and learn new terminology like utilization and trade lines and things like that are all pretty abstract from people's day-to-day financial lives, right? Credit scores are basically a reflection, they're a derivative prediction based on people's debt and their historical debt. Just one part of a consumer's financial life. Have you borrowed money historically from lenders that report to the credit bureaus, and not all lenders do, but have you borrowed money historically and what happened? That's basically what you have inside of a traditional credit file. What you don't have, right, are the other parts of a consumer's financial statements. Their income, their cash flows, their assets. All those things are inferred based on the debt, but not directly measured, and therein lies a lot of the distortions and so forth. There's also obviously a really big problem for anybody who hasn't been able to borrow money in the past. Right. And that's the catch-22 that's created by traditional credit scores.
Let's pivot a little bit to Prism Data. How did you decide to found the company or lead the company with this particular business model? And Tell me how, the path for product market fit went for you guys.
Yeah. So there's two companies that I've been a part of in this space over the last 10 years. Petal, which was a consumer-facing lending company, a credit card company, and Prism Data, which is a B2B analytics company, essentially doing next-generation credit scores with cash flow underwriting. A lot of people saw Petal first and Prism Data later. What they don't know is that actually the progression looked more like Prism, Petal, and then back to Prism. And what I mean by that is when we first started working on cash flow underwriting and going beyond traditional credit scores, we thought that we would create a B2B company, that we would create a new score that could be used by lenders and banks and so forth. But that was in 2015 and 2016. And this space was very nascent. Access to the expanded data that we use in our score was much more limited. There were open questions from a regulatory and compliance perspective about what you could do in this space. So it was too early. And there's a big chicken and egg problem with any new idea related to underwriting and risk management. It has to be well proven before anybody is going to adopt it and put their own money on the line. And so we had to prove it ourselves. And that was the genesis of Petal. In a way, it was our testing ground for cash flow underwriting. So we created a consumer lending business that utilized cash flow underwriting heavily for people who didn't have traditional credit history and didn't have access to the credit system. So the Petal credit card is directed towards people that have thin and no credit files. So think about young folks like students or recent graduates, folks like my co-founder that are new to the country, people who served in the military. A lot of reasons why you may not have built credit history previously and can have a disadvantage as a result. So we used cash flow underwriting and we found that it was extremely useful to safely extend credit to these segments of the population that weren't being served by banks or other lenders. Fast forward, 5 or 6 years of doing that to the tune of billions of dollars in originations, hundreds of thousands of customers that we had worked with, millions that we had evaluated, right, in terms of credit applications. The cash flow hypothesis that we had proven out. It became the most powerful component of our underwriting. We learned that, in fact, it was applicable not only to people who lacked credit history, but it told us a lot more about people who had full credit scores as well. And it was finally the right time to come back around and build that B2B company that we wanted to originally.
I love that. So talk to me about after Petal, or even during Petal, what was the use cases where you got the most pull for Prism Data? Where was it that basically there was a deep pull from product market fit to go and just focus solely on Prism?
The Prism story really starts about 5 years ago. Okay. That's when we created Prism, first as a separate subsidiary of Petal, and then we spun it out into an independent company, which it is today. Right. For Prism, we formed the company at a time of rapid adoption of real-time data access. So cash flow underwriting derives from banking history, bank account transactional data, which is really the line-by-line record of everything going on in a consumer's financial life. It's the information that's contained on a consumer's bank statement. It's really, if you think about it that way, it's not revolutionary at all to use bank statements in underwriting, but the data is digital, the models are very sophisticated, we're using AI and machine learning, so those are the new and exciting components of it. We created Prism at a time when it had become much easier for consumers to access and share their bank account transactional record. And we found that more and more lenders were looking for ways to safely expand their customer bases, to approve more of the folks for credit that were applying. And all lenders are always looking for ways to better manage risk and to reduce losses, which are very painful. In particular, I'd say in the credit card space, personal loans, auto loans, and small dollar credit, there's been very rapid adoption of cash flow underwriting in the last 5 years, and we've been a part of that.
Maybe to make it really concrete for the people, what are the top 2 or 3 use cases for consumers where credit scores have failed them? I mean, one example is your co-founder, and cash flow underwriting now is actually working.
Yeah. So let's take the tens of millions of people in the US that have thin or no credit history. That's the most simple, most pure application. So, here you have folks that either don't have a credit score, or they have a credit score that's low because of a lack of information, not because they've done anything wrong. And if you find yourself in that cohort, which, by the way, we're all born in that category.
Right.
Right.
What proportion of adults in the United States don't have or have very low credit score history?
So about 50% of the US population has a credit score below prime.
Okay. Wow.
And then of that 50%, you've got a good like 25% that are thin file, no file.
Wow.
So these are really big categories. And by the way, there's a 50% of people that have a credit score worse than prime. Only a small fraction of those will ever actually default on a loan. What you have, the difference between those two, the delta between half of the population and maybe 10, 20% of the population that will ever go delinquent on an obligation, the delta there is the cost of uncertainty. It's that the lenders can't figure out who to trust and who not to trust with the legacy tools that have been available to them. And so as a result, they have to group all those people together and they can't serve them, right? So the numbers are quite large. If you don't have any credit history, you're stuck. You either can't borrow money or you have to pay really high rates. And you're locked out of a lot of asset classes, like obvious big things like mortgages and small business loans and things like that. So that's the first one. But there are a lot of other use cases. And they're use cases that can apply to anybody who's watching this. So imagine you're applying for a new car loan, for instance. And you're figuring out what financing is available to you, what your down payment is, and then the APR, the monthly payment that you're going to end up paying. Today, we're working with auto lenders to say, hey, here's the down payment and the rate that you qualify for based on your credit history. Now, if you'd like to share more information, share your banking history as well, we can get you a better APR, a lower down payment.
Wow. And so the use case is you will sell to particular lenders, car loans, mortgages, whatever that is. Mm-hmm. And then the use case is someone who's unhappy with the offering. Maybe they also get fully denied. Mm-hmm. Maybe they, the price is just outrageous for what they were estimating. And then by connecting, I mean, that makes a ton of sense.
Yep.
Maybe this is a crazy question, but why aren't the credit bureaus and the entities that work around the credit bureaus invest more in cash flow underwriting?
I think they are.
Okay.
I think they are. One of the very significant relationships that we have at Prism is with Equifax, where Equifax now licenses and makes available our score, which is called a cash score, and some of our other analytics to their existing customers alongside traditional bureau data and traditional credit scores. One of the things that we found analytically is that cash flow underwriting tells you something that's wholly different from what a credit report tells you. And they're both very valuable. The two sources of information are more independent or orthogonal than you would think. So all the time, to make this concrete, we see people that have low or no credit scores, but have really good cash flow and are good credit risks. And we also see the opposite. We see people who have high credit scores, they're actually riskier than their score would indicate. And so, working in concert with the credit bureaus, we're able to bring the best of both worlds to make more comprehensive credit decisions, which is where the whole market is moving. So we are seeing the incumbents lean into this. Experian has an offering. Equifax partners with us. FICO and VantageScore both have cash flow underwriting offerings in the market as well. So everybody is buying into this, but we've been doing it for longer than just about anybody else.
Well, let's talk a little bit about what being in it longer allows you to do, and maybe that's a question about AI and machine learning. And since we're in the age of AI, and everything is touching that these days, talk to me a little bit about maybe some of the differentiation you have there.
Yeah. So the world of cash flow underwriting is brand new. And if we compare it to traditional credit bureau data, we've had decades and decades of maturation in that process, in formalizing and standardizing the way that information is collected, the way that it's made available to the market, and the way that it's utilized. None of that really exists in the world of cash flow underwriting, or didn't exist at the time that we were getting started. So the first layer of it is just understanding that bank account transactional data in a very accurate way, which is easier said than done. If anybody looks at their bank statements, they can see the kind of messy list of different transactions that live there. It's not always clear what's what. Merchant information is reported in inconsistent ways. And bank account transactional data is always changing. There's new stores popping up, there's new transaction types in the marketplace. So the first thing we have to do is understand every one of those transactions and what it is. This is where we're really leveraging AI. We have a very sophisticated transaction categorization system that we've developed over a long period of time that's seen billions and billions of transactions that accurately identifies what's what. That's step one, but if you get that step wrong, everything else that you do is going to be compromised, right? So we start there. We then have developed over the years more standardized measurements of the sorts of things that you care about in bank account data as it relates to credit risk. So you don't care that someone got a cup of coffee on Tuesday, but you might care about the percentage of someone's paycheck that goes to dining out on a monthly basis and how that fits with their overall budget, right? So we have thousands, actually tens of thousands of different measurements that we've created over time, some that are very intuitive and obvious, and others that are much more nuanced and complex and sophisticated. So lots of different things that we can measure in the bank account data. And this is analogous to the things that are measured from credit reports, but it's more expansive.
Right.
And then finally, when we build scores, and like I said earlier, we have a score that is a next generation credit score based on cash flow underwriting. We call it a cash score. That score originates from a very large consortium of data that we've built over the last 10 years. Over 100 different lenders have contributed data to this consortium. It is millions and millions of consumers' bank account information and credit outcomes, and that allows us to build a general purpose score that is going to be predictive and applicable no matter where you apply it, whether it's a buy now, pay later transaction or a credit card approval or an auto loan.
Yeah, the basis of the pyramid of what you're building is the quality of the data you get.
Absolutely.
What kind of data do you think is potentially the holy grail here?
Yeah.
Is there any that you see as the holy grail? Is there like a next gen set of data that could be accessible that would help?
Right. So, going back to the limitations of traditional credit scoring, it really comes from two things. It comes from the fact that credit scores are based on just the liability side of the consumer's financial life, so missing the assets and the income. And then the data is also fairly stale. Right? In order for data to make its way into the traditional credit bureaus and into credit scores, it has to be reported by lenders, which they do on a monthly cadence, and then eventually it filters its way into the scores. They tend to be pretty lagging indicators. And increasingly, the provision of credit and the management of risk is happening in short durations, in more real-time type interactions, right? So bank account data is something that can be accessed in more of a real-time way. Same thing with payroll data and some of the information that you all use at Clair. I think that we're all part of this evolution towards more real-time information, which of course improves vastly the quality of the decisions that are possible.
Yeah, so Clair's business model, like how do you think, even for the public, is a world where Clair and Prism could work together because of the diversity of the data that is accessible?
Again, think about that gap between the number of people in the US that don't have good access to credit and then the very small minority of those people that are actually high risk, right? We have the ability to close that gap. And in doing so, expand access to credit, so giving people more financial opportunities, whether it's to borrow money for a student loan to go to school or to start a small business or what have you. And we have the ability to lower the cost of credit because that uncertainty, the amount of time that lenders get it wrong, right, that has to be priced in. And it makes credit more expensive for everyone, including all the people that are going to pay it back, right? I think innovations like what you all are doing at Clair and what we're doing at Prism and combining real-time data, bank data, payroll data, right? That has the ability to fill in these blind spots and close the gap, giving much more people access to credit at lower cost. And that in turn drives the economy, drives upward mobility for consumers. There's all kinds of great things that can accrue from that.
Well, maybe one last question for you. Fast forward 5 years.
Yeah.
Where's Prism Data?
So, we have pretty big ambitions at Prism Data. We think that, we are on the cusp of really leaving legacy credit scores in the past. And like I
love
said,
that vision, by the way.
like I said earlier, the credit score is important, and the information that is described in the credit score is critical financial information, but it's not the whole picture, not by a long shot. And so I think that we are entering a world finally where the legacy credit scores, right, that have been pretty static for the last 50 years are going to evolve into something that is more expansive and that is more real time across the marketplace in all different forms of credit and lending, consumer and small business, and not just in the United States, but all over the world.
Jason, thank you so much for making it.
Thanks for having me. Great chatting with you.